My prediction, 8% on 10-year yields, is medium term by the end of the decade. I provocatively said, but it was not for provocation, I believe it, that 20 years from now, not this year or any of the decade, potential growth in the US could be as high as 8% rather than 1.8. Really, growth becomes exponential. I mean, really stuff we've never seen, even in US history. But the unemployment rate could be as high as 80%.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest earned well-deserved fame by successfully predicting the 2008 financial crisis. I'm pleased and honored to welcome to the program economist, author, and educator, Dr. Nouriel Roubini, the co-founder and chairman of Roubini Global Economics. As he makes his first ever appearance on this channel, hopefully the first of many, let's ask him about his macro outlook for 2025. Dr. Roubini, thanks so much for joining us today.
Great pleasure being with you today. Yep.
Thank you. Well, it's a great pleasure having you on the program here. I've got a lot of questions for you based on a lot of your recent work, your books, some recent interviews you've done. But before we get to those, I'd like to just start this conversation with a general question, intentionally broad general question that I ask everybody at the start of these interviews. What's your current assessment of the global economy and financial markets?
It's hard to tell because, of course, there's the US, Europe, emerging markets, China, and it's hard to generalize. And when people ask me about what's the state of the world economy and market, I'm reminded of towards the end of the Soviet Union, the Prime Minister of the UK, I think was John Major, goes to Moscow and he meets the Secretary General of the Communist Party. And he asked him, what's the state of the Soviet economy? Can you tell me briefly? So the communist leader looks at him dourly and he says, good. Major is perplexed and says, maybe you can elaborate in a couple of words. So the Secretary General looks at him dourly again and says, not good. So if I had to say what's the state of the world economy in one word, I would say good. In two words, not good. Why I say that? The good news is that we have not had a global recession in the last 2 or 3 years, in spite of the fact that inflation after COVID got out of control, both in advanced economies and emerging markets. And the conventional wisdom among most economies was as the Fed and other central banks are going to increase interest rate to fight inflation, of course we're going to have a recession, because in US history for the last 60 years, anytime inflation was above 5% and unemployment was below 2%, and the Fed increased interest rates, we ended up in a recession. So for a whole bunch of reasons we could discuss whether it was lack of policy, we end up in not there. That's the good news. We avoided the US and global recession. The bad news is that many parts of the world are growing in a mediocre way. Many emerging markets are fragile. Even China is growing closer to 3-4% rather than the 8-10% of the previous decades. Some economies and markets are very fragile. US looks like is exceptional. People refer to the US exceptionalist because US growth for the last few years has been above potential, estimated by the Fed to be only 1.8. Last year we grew 2.8 while inflation was falling. Was it a miracle, good policy, good luck? We don't know. But US is exceptional. Most advanced economies are growing poorly. This year US growth could be 2.5%, while in the Eurozone might be only 0.8, 1/3 of the US growth, just to give you a comparison even among advanced economies. And of course, 60 poor countries in the world are considered bankrupt, insolvent by the IMF and World Bank. They will not be able to pay back their foreign debts or public debts. They'll have to restructure. Those are fragiles. There are, of course, pockets of the world where geopolitical tension are leading to war: Russia, Ukraine, Israel, Gaza, and the Middle East. And that creates not just political tension, but also economic. And even in the US, think of it this way. During the Biden administration, growth was above potential. Inflation surged, but then it fell towards 2%. Bond yields remain low, and stock prices went through the roof. With that type of economic, performance, historically, whoever was in power, incumbent, should have won by a landslide. And instead, Trump beat Kamala Harris. Why was that the case? Is that while the macroeconomic data on average suggests strong growth, low unemployment, stock market all-time high, many people feel left behind. There is a rise in income and wealth inequality. There is a rise in economic insecurity. 80% of the stock market is owned by the top 10% in the distribution of income. Most people don't have any stocks, so they don't get that benefit of a rising stock market, while bond yields now are 5.5%, and therefore mortgage rates are above 7%. Anybody who has a mortgage, student loan, auto loan, credit cards, personal debt is squeezed. A good third of households live from paycheck to paycheck. So the top households are doing well. The bottom quarter to 30% is struggling. And it's been struggling for not the last 4 years, for the last probably 30 years. Mm-hmm. Doesn't matter whether it's Democrat in power or Republican. People, many working class, maybe people even in the service sector, are having a hard time. And that's why the combination of economic inequality, economic insecurity, fearing that your future is shaky, the one of your family and children is shaky. Inflation, of course, was part of the story. And on migration, people, of course, loose migration policy led to the backlash against it. But the fact that the reason why people are, left behind has very little to do with the migrants. If anything, the net impact of migrants on growth and lots of things can be positive for the US. But we know it, I've seen it throughout history. When things are going poorly, you are blaming the stranger. The stranger sometimes can be the Jew, sometimes can be the Muslim, sometimes can be the gypsy, sometimes can be the homosexual, sometimes can be the foreigner, the bad hombres who are coming, invading our country and destroying our jobs and being murderers and criminal and rapists. That's the rhetoric. It's total nonsense. But when people are afraid, they become nativists, they become nationalists. They feel that, they're threatened, and anything that is different from them, if you're white, religious, evangelical, or Christian, then everybody else looks like a threat to you. And that's part of what's happening in the US right now. So there is lots of malaise, but those are deep and structural problems. They're not problems that are going to be resolved by anybody, not even by Donald Trump.
Okay, so we've got the US as the lead sled dog here in the global economy, but even the US is not without its problems. And I would say, Dr. Roubini, you're taking this conversation exactly where I was hoping to. And this sort of K-shaped recovery, that you're talking about, where a large part of the public is on the downside of the K. Yes, that's very true here in the US, but it's also very true in a lot of other Western countries, right? It's just not unique to the US, right?
Absolutely.
Okay.
Yeah. People have referred it to the K-shaped recovery. So for a while, the issue was, would it be a U-shaped recovery, slow and gradual, V-shaped with rapid return to strong growth, or L-shaped where we stagnate? People came out with this moniker of the K-shaped. Those who are in the top are doing better. Those who are in the bottom are doing worse. And therefore, you cannot lump it all together. And you have to distinguish between those who are left behind and those who succeed, those who are winners and those who are not winners. And that explains a lot of the political and social trends of our times as well, right. Within countries and across countries as well, I would say. It's both domestically and internationally, yeah.
All right, so I'm going to keep pulling on those threads throughout this conversation. But let me just ask, so I think you just gave a great synopsis on kind of the macroeconomic side. Just curious, do you have a thought about the financial markets right now, given their current state?
Well, again, US is different from the rest of the world. The US, the last 2 years, 23 23 and 24, the S&P, the broad index of the market, went up by 20% per year. Of course, the tech stocks more so, the Max 7 even more so. But in many other parts of the world, say China, equity prices have been stagnant for a while. In Europe, they rallied a little last year in spite of mediocre economic growth, but PE ratios and valuation, of course, in Europe are, in other advanced economies, are much less than the US. In part is because, the US is really exceptional, stronger growth, both cyclically and also structurally. And the technology is going to lead us to even more strong economic growth, while innovation is weak in most other advanced economies. So the differential in equity market can be explained. Of course, people look at the US and they say, the stock market is all-time high, and not just all-time high, but PE ratios, price to earnings, are to the roof in the top 10% quintile or whatever distribution. There's frothiness, there are bubbles, and then there could be a correction and this and that. I don't rule it out. The question is, after 2 years of 20% returns, what's the baseline for this year? So my baseline is not 20% plus, is not 20% down. There will be not a correction, but a bear market. Probably I would say that the overall indices in the US this year will have positive returns rather than negative for the year. But probably there will be certainly, I would argue, single digits. And if we're lucky, in the mid to high single digits. But you could have them doing more poorly than that. Why do I say that? That middle view? Probably earnings growth is not going to be as rapid this year as it was the last few years. Growth will be a tad softer. Inflation might be a headwind. The Fed may not cut rates much more. In an extreme scenario where policy of Trump may be inflationary, they may even be raising rates. So you have PEs that are already too high. Earnings growth is going to slow down. The Fed is not going to cut rate that much, at best once this year. And P ratio can maybe either stay at the current high level or compress a little bit. But even if they don't compress and they stay at current high levels, if earnings growth is going to be overall in the mid to high single digits, that doesn't justify double-digit returns for US equities, justify only single digits. And widening of those P ratio is unlikely, given how stretched they already are. If anything, they can contract. If they contract enough, even with positive earnings growth, you could have an overall correction of the market this year, but that wouldn't be my baseline. So I would say you'll get positive returns, but are moderate, and compared to cash can still give you 4 or 5%, say, safe short-term treasuries, then it's not as compelling to be in the stock market. And I would say there's more downsides than upsides. Some of the policy of Trump, as I've written recently, could increase growth, reduce inflation, more pro-business, lower taxes, deregulation, more fossil fuels, technological innovation, DOGE. But there are many policies that actually could reduce growth and increase inflation. Tariff protectionism, deglobalization, trade wars, draconian restriction to migration, net zero if you close the border, net negative if you deport lots of people. He wants to make the tax cuts permanent, those 17, and promises other things, but he doesn't have ways to fund it. So if deficit go higher, and they're already close to 2 trillion, then bond yields go higher because the bond vigilantes wake up. Higher bond yields means it implies lower economic growth, lower stock market valuation, and the market punishing you for poor economic policies that are inflationary. That's a risk that leads to a correction in equities. If bond yields were to go, say, 10 years to 5%, then say 10% correction in the stock market becomes likely.
Okay. All right. So what I hear from you so far is rest of the world lagging, U.S. doing pretty well, though it's got its issues. Markets are richly valued, but you're not ringing any real big warning bells. Your baseline assumption is that, probably have single-digit returns this year. We call those historically average, right? That might feel low to somebody who's gotten used to 20% returns, but it's more historically average.
A
But
little bit below average. The S&P on average does more like 11, 12% in the very long term. 20 is an exception on the upside. Middle single digits is below average. It's still okay, but it's below
okay,
average.
but below average, but still okay.
Yeah.
But I hear you saying, the risks are more to the downside than the upside here for a lot of the reasons that you just
Yeah.
mentioned. Okay, so here's where I want to go with this, and forgive me, I'm going to try to get through a lot in a short period of time. So I deliberately tried not to pull your moniker into the intro, but you are known as Dr. Doom for mostly predicting the 2008 crisis, but you've also had some risks that you've been very focused on. Are you taking that hat off when you look at the U.S. here? And I guess where I'm going with the question I want to ask you here is did the U.S. manage to dodge the hard landing bullet? Everybody thought, as you said, we were going to have this recession. Did the Fed and the other central planners kind of manage to find a way to thread the needle here? And are we going to get through all this with some of the best growth in the world and having avoided a recession?
Well, the simple answer will be yes. I would say of the scenarios of the US economy, the hard landing recession scenario has a very low probability. I would say maybe 10, 15%. Majority of people believe we're going to be in a soft landing where we're going to still grow, maybe slower, closer to potential, but inflation is going to go towards 2%. I would say if there's an alternative to the baseline of a soft landing, the other alternative is rather than a hard landing is a no landing zone. And by no landing, I mean a situation where US economic growth remains strong, above potential. After all, last year 2.8, previous year 2.5, this year expect to be 2.6, 2.7. And if the growth remains above potential and unemployment is low and remains low, then wage and price inflation that has fallen may remain sticky rather than falling towards 2. And then if some of the Trump policy on trade, tariffs, on migration, draconian restrictions, and large deficits that one, increase overheating, and 2, lead to higher bond yields, all those are recipes for essentially having slightly weaker economic growth and slightly higher inflation. So we end up growth above potential, but lower than last year. Inflation sticky, closer to 3%. And if those policies become really radically inflationary, one possibility, then you might actually end up with really higher inflation. So no landing looks more likely. Now, there's a risk that no landing, because we're already growing faster than potential and we have inflation above target, no landing actually could end up into not hard landing, where you have a recession caused by weakness in aggregate demand, so negative growth and lower inflation, but it could end up into stagflation, where you have a recession, but inflation is higher. Because if you are no landing zone and your policies are stagflationary, because protectionism and migration restriction and having deficit that overheat the economy, but they cause also more inflation, and the higher interest rates crowd out growth, all those things can push us from no landing into a stagflationary hard landing rather than in a deflationary hard landing. So that's an eventual risk, but it's not yet material.
Okay. All right. A good last qualifier there. Okay. Not yet material. So you warned about stagflation in your book, Mega Threats. In fact, I think you used the term a great stagflation was something that you were concerned about. And I'm just curious, now that we have the new Trump administration in power and we now have a sense of what their priorities are, do you think the stagflation scenario is more or less likely under Trump?
I've written recently that some of the economic policy of Trump may over time to lead to higher growth and lower inflation. So that's really a Goldilocks scenario. Some of his policy may lead to the opposite, to lower growth and higher inflation. That will be stagflationary. And then the question is what restricts bad policies. The good ones are the one we know, is pro-business, animal spirits, business sentiment is improving, there'll be more economic activity. Two, he wants to make the tax cuts of the 17 permanent. Lower taxes on capital, corporate, and labor are good overall. Three, he wants to deregulate the economy. If he does it right, maybe we get a little bit more of growth and competition. Four, he may get out of the Paris Accord, but he's going to produce more fossil fuels. It's bad for the environment, but he can keep energy prices cheap, lower inflation, and attract energy-intensive sectors of the economy, like data centers. Five, you have the Doge kind of thing. I don't think you can cut $2 trillion a year. You'd be lucky if you cut 200 billion. That's good enough. It's 1% of GDP. There's plenty of waste. And six, is lucky. He's lucky because whoever was going to be in power, you could have a monkey and a dumb monkey in power. Our political system is dysfunctional, but our private sector is dynamic. And there's a revolution is AI, machine learning, robotic, automation, biomedical research, quantum, space exploration, exploitation, green tech, ag tech, fintech, mobility revolution, new material science, new weapon systems that are semi-autonomous. You have about 12 industries of the future where growth is going to be higher. So we're going to be in a higher growth scenario regardless of his policies. He's just lucky to be president at the right time in the right place. That's on the positive. On the negative, things that can reduce growth and high increase inflation are known. Protectionism, trade war, decoupling, deglobalization, full economic war with China, draconian restriction to migration, net zero, net negative migration through massive deportation, tax cuts are unfunded. He doesn't just want to make the tax cuts permanent. He made 10 other promises. It's going to cost us $8 trillion or 800 billion per year. Deficit blowing well above 2 trillion. He wants to reduce the independence of the Fed that can feed inflation expectation. He wants to weaken the dollar. He believes it's too strong. That can lead to disorderly inflation. And six, rule of law. I mean, rule of law is being reduced at home and abroad. At home, oligarchy, nepotism, plutocracy is not good for competition. Competitive system, everybody competes, but in a world in which your friends and allies get favors and government procurement, the Elon Musk of the world, and the tech guys who are not your friend get punished, and everybody else depends on whether is your friend, your enemy, is not what democratic capital is supposed to be. And in the world, you're pissing off everybody, including your allies. You're unilateralist in a way that weakens the soft and the hard power of the US. That's not going to attract investment in the US. So, don't want to be two-handed. Economy is 6 good, 6 bad, because I think that the bad policies are constrained, one, by market discipline. Bond vigilantes waking up if your inflation goes higher, pushing yields higher, punishing you through stock market correction. You can control your party, you can control Congress, you can control the judges, you can control the Supreme Court, you can control even social media, control X, you control that, but you cannot control the bond vigilantes and the stock market vigilantes. The former political advisor of Clinton, Jim Carville, said 2 things important. First, it's the economy stupid. And 2, said, in my next life, I want to be born as a bond vigilante so I can go and boss around and punish all my enemies, especially policymakers. So the power of the market is what constrains stupid policy, first. 2, Fed is independent. If it does policy that cause inflation, the Fed may even raise rates or not cut them at all. That's going to constrain him in spite of his threats on the Fed. 3, you have to give him credit. His economic advisors are reasonable. You know, you have a bunch of weirdos at the FBI like Kash Patel or Pete Hegseth, who is a totally incompetent guy running an $800 billion budget and 3 million employees of the DOD. But Scott Bessent, Steve Miran, Kevin Hassett, Howard Lutnick know economics, know the markets. So they're going to tell him, Mr. President, if you do stupid policy like on trade, the market is going to punish you. And if it still does them like last week, then the market punish him. And they're going to go and tell him, you see, I told you so. You want to double down, or you want to negotiate and start to do something more constructive, and be forced to be more constructive. 4, you know, he has a very thin majority in the House, two votes, 3 in the Senate. And therefore, if he does stupid things on tariffs, not by executive order, but using legislation, some of these people may vote against it. So you have 4 guardrails that constrain the stupid policy. So the net on growth is a wash. The good and the bad stuff wash out. But the net on inflation, I think, is more like bad policies, like on trade, migration, and deficit, push inflation higher. And the good policy that reduce inflation, like deregulation and more fossil fuels, take a long time. They take 3-4 years. They're not going to happen overnight. So the bad stuff can push inflation higher this year, while the good stuff may reduce it 3 years from now or 4 years from now. So the net of it is a slightly more persistent and sticky, if not higher inflation than the last year. That will be my net of it.
All right, Dr. Roubini, I've got to commend you. You do an excellent job as an interviewee, because you tend to anticipate the questions that I was going to ask as a follow-up. So thank you. You're making my job easy for me. All right, so it sounds like, if I heard you right, that more or less you kind of look at Trump as a package, as mostly a wash between good and bad, except you think that net the inflation risk could be higher in the near term with him. So there was an article written about an interview with you back 2 months or so ago, and I know you don't control the headlines that get written on your interviews.
Yeah, I don't. So I can say one thing and then they take a soundbite on what sounds catchy. So and then they make of it as if it was my punchline. So
right. So I want to give you the chance to clarify this.
Yeah,
but
please.
The famed economist Nouriel Roubini warns another inflation flare-up is on the way, threatening to sink the stock market and send 10-year Treasury yields to 8%. Now, listening to you here, I don't know if you're necessarily predicting a massive runaway inflation. I mean, it could happen, but I don't think it's what you're saying. You told me your default is already the stock market's probably going to have an okay year. You know?
Yeah.
Treasury yields to 8%. Is that something that's really kind of in your base case, or was that a little bit more hyperbole in the headline writer there?
No, my prediction 8% on 10-year yields is medium term by the end of the decade. And for that to happen, you don't need hyperinflation. You don't need high inflation. You don't even need double-digit inflation. Let me assume for a moment, and I'll explain you why it's likely, that the average inflation rate by the end of the decade is not 2%, but say 5-6. And I've written an entire book on why on the supply side, there are negative aggregate supply shock, including deglobalization, geopolitics, that create more costs and more friction and reduce growth. And 2, why on the demand side, we have large budget deficits that we're not going to be able to reduce. And with too much spending, not enough taxes, eventually that explodes unless we wipe it out with some unexpected inflation. So I'm actually very conservative. I'm saying inflation not going to be even 10%, not even 7-8, maybe 5-6. That many people actually think is very reasonable given what could happen on the supply and demand side. And I want to speak about this year. As I said, by the end of the decade, I can tell you a long story. I wrote an entire book. So let's assume inflation is 6. What will be the 10-year Treasury yield? It has to be at least 6% for expected inflation. That's simple. And then there is the real rate. And the real rate has to be higher during the great stagnation or the secular stagnation of the GFC, of course, was zero. But today, the debt term premium in real terms is already 0.5 going towards 1%. And most economists, Goldman Sachs, JP Morgan, estimate that with our deficit and our debt, the equilibrium real long rate is going to be at least 2%, but it's not very high historically. So 6 plus 2 gives you 8. As simple as that. With inflation around 5-6, it's not something crazy. Of course, in real terms, only 2. In nominal terms, is 8. But then mortgage rates will be at least 10%. Yeah. Today, people struggle with mortgage rates at 7. So that's not a happy world. So you don't need to be doom and gloom. And I tell you, even if you don't believe that your baseline is 5-6%, you have to assign probability. And I tell people, even if the probability of that is not 50 or 60, but it's only 30, it has massive consequences for your investments, including what's the defensive asset that traditionally has been long duration treasuries. But if bond yields go from 4.5 to 8, then you lose 40% on your bonds that are supposed to be the safe defensive asset when things go back with bonds, with equities. And with 8% 10-year treasury yields, the stock market corrects at least 10-20%. So you lose money on the safe asset, the bonds, you lose money on equities, and you lose more money on the bonds than you lose on the equities. Like it happened in 2022, when inflation went high and the Fed rose rates, 10-year yields went from 1 to 3.5. The price fell 20%, while in 22, S&P fell only by 15%. So you lost more money on the safe defensive asset, long duration treasuries, than you did on the US equity market. And that thing can happen even in this very baseline scenario that I described you, of inflation gradually going to 5-6. And we're closer to 3 right now. We're not closer to 3, to 2. So we're already 3-ish. 2 years ago, we were 6-7. And I'm saying we're not going to move towards 2. We're going to move gradually over time towards 5-6. So it's not doom and gloom. It's just something that is meaningfully possible, right? And then you decide how likely.
Although not doom and gloom, but as you said, if we get up to a world of 8% interest rates, 8% 10-year and 10% mortgage rates, that's not a fun world for people to live in.
No, it was terrible in the 70s when it was like that. It was a world of stagflation. Yeah. It was ugly.
Okay, so I'm going to get to in a bit asking you for kind of, given your outlook, what assets do you think are a good fit for the type of world you see? If on the way there, I can just ask you a few more questions. One is, I get the sense from some of your recent comments and some you've made in this conversation that you're kind of bullish about the prospects for the American economy in terms of technology, in terms of progress. Yeah. Okay. And I know you think AI is going to be transformative. I read that you actually think that DeepSeek is actually kind of bullish for the whole AI, even the US-based AI ecosystem. It's not necessarily so I'd love for you to expound on that, but let me ask a question for you to integrate in your answer. So a non-technologist layman like myself has a hard time looking at AI as not a massive jobs killer over time. And so in a world where, sure, economic growth is boosted by technology and AI brings a lot of efficiencies, but it displaces a ton of people. Is it kind of like the K-shaped recovery that we were talking about, right? Like it makes America look good from a GDP basis, but it makes it look worse from a societal standpoint.
The answer is yes. You get more growth, you may get permanent technological unemployment, and you get much higher income and wealth inequality. I provocatively said, but it was not for provocation, I believe it, that 20 years from now, not this year or any other decade, potential growth in the US could be as high as 8% rather than 1.8. Really, growth becomes exponential. I mean, really stuff we've never seen, even in US history. but that the unemployment rate could be as high as 80%. Now, the dismal part of it is that you get 8% growth and 80% of people are unemployed. And most of the benefit of that growth goes to the owners of capital and the machines and the robots, and the lucky 20% of people that are so skilled that they can use then ChatGPT and fancier version of it to become even more productive, even more efficient, even more profitable. That's the dystopian part of it. The less dystopian part of it is that growth is 8%. The economic pie grows very fast. There's massive inequality. A bigger share of it goes to the winners. But then we can tax the winners, owners of capital, and those who have labor income or entrepreneurs that win from it, and redistribute to everybody else. We make everybody else better off. Even if they don't have a job, they can just have leisure. And therefore, everybody's better off. Meaning it's better to have is it better to have a world of 8% growth with 80% unemployment, or is better to have a world of malaise like the last few years where growth is 1.8, unemployment is 4, but people feel like they're struggling. Now, of course, people want the dignity of work.
Yeah.
In a world in which there is no scarcity, you spend your time consuming, having leisure. So you have to change your attitude towards what the meaning of life is.
Let me just dig on that, because I think again, one man's opinion, it gets down to exactly what you just said there, the meaning of what life is. So if we can judge on history, right, you know, when you subsidize a large class and they don't have meaningful work, they tend to become a dependent class, right? And even when we give people exactly what they think they want, and a great example, you know, here's my iPhone, right? I've got all the knowledge of the world for free in my hand here. What do? You know, we watch cat videos and pornography, right? So we don't necessarily use the leisure time that technology gives us constructively, right? And I also wonder too, you know, if we almost kind of went through a UBI experiment during COVID, right? Where we just sent checks directly to households, and what happened? We saw a huge surge in the price of everything. And yes, there were some supply constraints, but if we just gave everybody, you know, a universal income by taxing the rich capitalists, wouldn't just the price of everything go up anyways? And people, you know, the purchasing power of that subsidy, that UBI, just become meaningless over time?
No, that would not happen, because you get inflation where you transfer people money through debt, not through taxing people. And then there is excessive aggregate demand. In a world of AI, the supply of goods and services explodes because the robots produce everything. Because of that, you'll have one massive deflation technologically. Mm-hmm. But in a world in which most of the income goes to 10, 20% of people, and 80% of people have no income, you have a depression of consumption. So what Karl Marx said. Karl Marx had the view that capitalism is going to destroy itself because capital is going to become richer, work is going to get less labor income, and there's not going to be enough consumption, and then the economy is going to crash. So a world of AI without UBI is a world where you have deflation that is good, the supply side, but you have also bad deflation that comes from like the Great Depression, lack of aggregate demand, because most people don't have any income, because you know, all the rich guys cannot spend all that stuff. So by definition, you have to tax the winners, give to the lost behind to avoid deflation. It's not inflationary, it's massively deflationary. So you have preventive massive deflation, and you prevent social political instability. Now, you're saying correctly, many people want the dignity of work. They don't want to be, unquote, considered as unproductive member of society. That's a different consideration. But there is a solution, and the solution is universal basic income. And by the way, we're already in a world in which massive inequality has been growing for decades. And the social welfare state, even in the US government spending share of GDP used to be 25%. In Europe, it used to be 50%. Now becoming like Europe. If you do central and state and local, government spending share of GDP is around 40%. Because actually our hyper-capitalist system compared to European leads to higher growth, but leaves also lots of people totally left behind. Mm-hmm. And to avoid literally revolution and civil war, we're already having a very, very progressive tax system that taxes those who are successful and redistributes, whether it's Social Security, Medicare, Medicaid, food stamps, unemployment benefits, and thousands of other programs are taking from the rich and giving to our left behind. You don't want to call it UBI, call it whatever you want to, but it is effectively a variant of UBI. So UBI is going to be only an incremental change in a world in which already a small minority of people are the winners and most people are left behind. And we're already creating a social welfare system to avoid the revolutions.
Okay. One guy's opinion here. Personally, I'm not sure either of those two destinies you mentioned are ones that we would want to aspire to. And part of me just would like to hope that there's maybe another option out there. Is there, or do you think it's inevitable that we got to choose one of these two?
I was making a statement not normative of how the world should be, but how the world is likely to be. So my personal preferences may be like yours. One is more equal ex ante rather than ex post, and people have the dignity of productive life and work. Some people are optimistic and say there are millions of jobs of the future we don't even know, like it happened after the digital revolution. Tons of jobs created out of nowhere never come, and we'll have something close to full employment. I think it's unlikely because when technology and productivity increased in agriculture and primary, people moved into industry. And when technology, because it was not trade, it was technology that led to manufacturing losses, people went into services. Well, we know that pretty much every service under the sun, eventually, actually, even sooner than manufacturing, can be replaced by technology. So we're going to run out of things that people do. Even the things that require, people say, personal care, right? Caregiving. I tell you, in Japan, where they don't have enough old people, so they have too many old people, don't have enough caretakers because they are against migration. They have robots who provide all this service to the elderly people. And actually, the robot is emotionally more intelligent than a human because a robot can see your face if you're unhappy, says, I see you have a sad face. What can I do for you? Is empathizing. But most human beings, so let's be honest, have zero emotional intelligence. They don't even notice that you're unhappy. So even on that stuff, even your pet can be a dog robot. And it talks to you rather than barking. So, unfortunately, I think we're moving in that direction. It's not that
so does Elon Musk,
scenario,
right?
But I think we're moving in that direction. The best we can do is to redistribute so that people have something to live on. But those people who have nothing else to do, eventually they don't even reproduce themselves, right? They're not going to have children, and therefore they disappear.
Well, we're already seeing that in Japan, as you mentioned. In fact, we're already, on our way there too here in the States, as I'm sure you know well.
Yeah, that's of despair, right? People who are incels, right?
Yeah.
They watch pornography and they cannot even find a mate, let alone a girlfriend. And therefore, after a generation, you give them video games, you give them some little stuff, they get the fentanyl or some other stuff, and they don't reproduce themselves. It's sad, but that's the direction we're drifting at.
Well, and I think a core part of that is the wealth inequality, the wealth gap that you've been talking about here, the fact that it's the despair of them ever being able to achieve it, in America at least, achieve the American dream. In Japan, we can call it achieving the Japanese dream. Right. And to your point, it seems no matter who's in power, Republican, Democrat, whatever policies are enacted, in the moment we can say that was the right thing or wrong thing to do, but over time, it's pretty undeniable that those policies benefit those that already have wealth, and therefore that inequality gets even larger. Dr. Roubini, I could talk with you about this for a few more hours. This is super fascinating, but I want to be respectful of your time here. So if we can shift slightly to, given the next remainder of 2025, right? We have your default assumption that markets will do mid-single digits-ish. Inflation's going to be sticky. Trump's going to be creating a lot of dust. Most of the people watching this channel we do have some professional investors, but most are just regular retail investors who are just trying to prudently grow their wealth. And I think they're probably a little relieved to hear you think that you're not waving your flag saying, hey, great financial crisis 2.0 is on our doorstep. So they want to play offense when it makes sense, but they don't want to get steamrolled by some crisis, coming out of the blue. When you look at the type of road ahead, what assets sort of make sense for what you see? Or what strategies?
Most traditional investment strategy is some variant of 60-40, right? 60% in equity, 40 in a defensive asset, like long-term treasuries. So my view will be along the following lines. I'll say you have to change your defensive asset, because if I'm right about gradual inflation going higher and deficit being high, nominal yields are going to go higher and real yields are going to go higher, because it will have more inflation gradually and will have high real yields because the deficits are too large. So if you have 40% your defensive in a long-term treasury, you're going to lose money, because 60-40 is based on the assumption that the price of bonds and the price of equities are negatively correlated, but that assumes low inflation. Traditionally negative correlated because risk on and growth, equity do well, bond yield go higher, the price falls, you make money in equity, you lose on bonds. Risk off or recession, equity fall, bond yields fall, the price goes higher, you lose money on equity, you make money on bonds. But that negative correlation assumes inflation is low and stable. Inflation is rising even slowly from 2% to 5-6, bond yields go higher, and you lose money on the unquote safe asset. Is not safe anymore. You can lose actually more than equity. And if 10 years are going to be at 8%, of course, equities are going to do poorly, like it happened in 22 and 23. And long duration equities like tech stocks are going to do more poorly than S&P, because long duration assets, the discount factor of bond yields matter more for them. So in 22, S&P fell 15% when 10-year treasury went from 1 to 3.5, but NASDAQ lost 30%, and growth and tech stocks lost 40-50%, right? So in that world, you want to be actually in even in equity in shorter duration equities rather than long duration ones. Even if tech has the advantage that because of technology, the earnings growth is going to be strong. So you want to be overexposed to big tech and Max 7 and so on, even with the current valuation. So I would say, first of all, what is the new, defensive asset when there is when equities go down? Is not long duration treasury, but is short-term treasuries. Yield can go higher, inflation is higher without the price impact. Inflation index bonds, gold, it's a good hedge against inflation, the basement of fiat currency. And some forms of real estate where rents can go higher because the supply of real estate is fixed in the short run. So it adjusts to higher inflation with high rents. So that combination of assets, maybe also some commodities, because inflation is good for commodities. So you have to have a bundle of things, not just long duration treasuries. Then on the equity side, I would say you have to think about a secular play. And the secular play is the future is all AI and technology. And whether you like it or not, the Max 7 are going to be the big winners, because all the Max 7, either they do lots of AI research on their own, say Google has DeepMind and Google Brain, or they invest in all the AI firms out there, the startups, right? OpenAI, 49% of it is owned by Microsoft, Anthropic, Inflation, all these guys own them. So the Max 7 are going to win, either because they win internally the AI race, or because they invest into those who are going to be the new emerging winners. So in spite of the high valuation, I would say Max 7 probably, and tech does better than S&P. And overall, even within S&P, they have old economy firms and there are new economy firms. And the old economy firms, if they don't adapt and adopt AI, may become obsolete and disappear. Take one example. GE used to be General Electric, a huge conglomerate and a multinational conglomerate. They made a whole bunch of mistakes and now is a shadow of itself. And technology was one of the factors, not the only one. So you have to think about even of the existing S&P 500 firms who are not directly in technology, which are the ones who are going to adopt the new technology, AI, and remain profitable, and which are going to be the ones who are going to become dinosaurs and are going to become less profitable and eventually going to disappear. So you have to also answer that question. But overall, I would say being in Max 7 overweight, being NASDAQ overweight compared to S&P, and within S&P being overweight in the tech and tech-related stuff, probably is the way to go. So you have to be exposed to the tech. That's the basic thing. And of course, picking the winner is hard. That's why you need a diversified portfolio of those tech firms.
Okay. So it's funny. I've shown a meme on this channel a fair amount recently, and it's an elephant balancing on a beach ball. And I have the elephant being global capital. I have the beach ball being the US stock market. So, a lot of global capital is finding its way into the US stock market right now. And then I have the beach ball being held up by a couple little ants, and the ants are the Mag 7 stocks. And I brought that up to have people talk about the concentration that we see in today's markets, right? Which is historically narrow, right? It's a lot of market cap in just a few stocks. I get the sense from you, that's not really a problem. You think that's the future. And so, it's okay.
Yeah. I hear all this argument on concentration and how that's going to burst and those P ratio, don't make any sense. But in the world where potential growth in the US is going to be 3, and the one of the Max 7 is going to be with high double-digit returns are going to continue for a long time. And if you take Max 7, maybe one of them fails. Maybe OpenAI destroys the entire search model of Google that is the major source of revenue. Big deal. Google is investing into AI, OpenMind that they bought for $600 million 10 years ago is worth probably internally $100 billion or more. It's the most important innovator in AI in the world, even more than OpenAI. Demis Hassabis, the CEO, got the Nobel Prize for Chemistry for the AlphaFold revolution. So, even if they were to lose all of search, Google is going to do well. Or suppose that Google fails, but then Microsoft owning OpenAI is going to be winner. So once you have a portfolio of those 7, either all of them are going to do well, or if 2 of them fail, the other 5 are going to do even better because they take all the market share of the 2 ones that have lost. So could the Max 7 correct 20, 30, 40%? Yes. Was the internet bubble went into bust when there was a crash in 2000? Yes. And the NASDAQ fell 60, 70%. But if you stayed out of NASDAQ for the next 10, 25 years, you lost a lot, right? And you wanted exactly to be in the NASDAQ. And even if you bought it at the peak and you had a 60% correction, 25 years later, you're still so much better off. So you shouldn't care. You shouldn't care about those dips will occur. Don't panic. Don't panic and start at the bottom. I should double down and buy the dip on the tech, I would say.
Okay, I hear you saying if you've got a long-term horizon, that this is going to be one of the key horses to ride. And I'm reminded of this. I used to work at Yahoo, and we had a CEO there, a guy named Terry Semel, who was a very successful Hollywood guy, and he came in and he actually did clean up Yahoo a lot, but he also made some pretty big blunders. And there were a lot of companies he could have bought, Google being one of them. But I remember when he was looking at buying Facebook, there was a potential deal and they ended up walking away from it because Facebook wanted $2 billion. And Terry Semel very famously said, I don't know how to value this company, but I can tell you this, that is not worth $2 billion, right? And so he walked away from the deal. And of course, over time, $2 billion would be the deal of the century for Meta now, right? So I kind of hear you saying something
right now, no?
Pardon me?
It's worth 2 trillion.
Yeah,
Trillion.
yeah. So I kind of hear you saying, hey, it's kind of like this, where people are looking at these stocks that are at crazy price to sales ratios, and they're 40% of the S&P market cap and all that stuff, and saying, these stocks can't be worth this much. And I think you're saying, in the immediate term, who knows? But if you get a long enough time frame, they're probably a bargain right now.
Yes, I would make that argument. Yeah.
Okay. All right. Well, thank you so much. One last question for you here. When you went through your defensive assets, your new defensive assets, you mentioned a bunch. I'm just going to ask it because of all the all the attention around it right now. You didn't mention Bitcoin. Do you have an opinion one way or the other on Bitcoin?
I've been a skeptic of cryptocurrencies for a while. Out of 20,000 ICO, 80% were a scam to begin with, and at 17%, the price fell to zero. 600 are left. Apart from the top 10, most of them have lost 50, 70% of their value. In my view, they're not currencies. They'll never be currencies. They're not a unit of account. They're not a scalable means of payment. They're not a stable store of value. They're not a single numeraire. Take El Salvador made Bitcoin a legal tender. That means that any store is forced to accept Bitcoin as a payment if you want to pay in Bitcoin. Which percentage of transactions occur using Bitcoin? 2%. This is after 5 years. So too volatile to be a currency. Period. It's never going to happen. Would there be a store of value? Some of them, maybe, but highly volatile. And Bitcoin went to 69, then fell to 15, then went above 100, now back to 90 or less. Even with the current valuation, that may be a $3 trillion asset class in a world where financial assets are over 100 trillion, and then you have real assets, infrastructure, real estate, and others are worth so much more. I think that they're too volatile. People want to make a quick buck. They want to become rich and overnight, whether it's Bitcoin or shit coins or meme stock or meme coins or SPACs or day trading. The right thing for any person is you should save some of your income, however difficult it might be. You should put in a diversified portfolio. You should never trade. You should buy S&P or NASDAQ or some other index of the market, passive. You have no transaction costs, no taxes to pay until you retire, no nothing. And S&P does 12% per year. NASDAQ has done 16 for decades. Even the best hedge funds in the world, they charge you 220 or 330.
Right.
I don't have those types of return. So that's what you should do. And if you buy the meme or the shitcoins of the world, you always buy at the peak, because that's when there is FOMO and everybody jumps in. Who are the people who bought Bitcoin when it was 1,000 or 10,000? A small fraction. Everybody bought it, when it was 100, and then it falls. So you buy the peak because of FOMO, then it crashes, you sell in a panic, and you lose money. It's not something that any person with sensible should be playing. It's a scam. It's a total scam. It's a bubble. It's a Ponzi scheme. Doesn't have any underlying value. People say because it's scarce. Lots of things in the world that are scarce are worth nothing. Scarcity doesn't define value. And gold, in my view, it used to be a currency. It's not anymore. It's stable. Gave you 40% return last year. Has gone up 8% in the first month of the year. I think if you want to go into traditional gold. You cannot. You shouldn't go into what people call digital gold. That is neither digital nor gold.
All right. Well, look, thank you so much.
That's my take on that one. It's too risky, too volatile, full of scams, full of shady people, crooks. It's really a scammy world. Bunch of crooks, criminals, carnival barkers, and sleazy people. And they screw you over. As put your money into Bitcoin, you lose your key, private key, your money is gone forever. somebody steals your private key, you're gone forever. With traditional investments, somebody steals my credit card or my bank account number, make a phone call, freeze the account, get a new card, I'm made whole in 60 seconds. With crypto, anybody steals your private key, your money is gone to that big black hole forever and ever. You're not going to receive a penny. And there have been millions of people have been shafted that way. It's a huge risk. There's no safety, zero safety, zero.
Well, one of the things I'm appreciating about you through this interview, Dr. Roubini, is you don't mince words. You're a very straight shooter. You make it very clear where you stand. So that's wonderful. Look, for folks that have really enjoyed this conversation and would like to follow you in your work, Dr. Roubini, where should they go?
If you go to nourielroubini.com, it's my website. There's access to some free things, links to stuff that is more proprietary. I have a bunch of economic consultancy for different levels and degrees of sophistication. So that's maybe the first stop for the many of things I do for different types of investors.
Okay. Dr. Roubini, when I edit this, I will put the link to your website up on the screen so folks know where to go. Folks, I'll also have a link in the video in the description below the video too, so you can just get there with a click. And did I read correctly, Dr. Roubini, have you launched an ETF?
Oh, yeah. First time I'm more into active asset management. I took some of the ideas of the book that will live in a world of inflation to think about what I was saying should be a defensive asset substitute for treasuries. And this ETF essentially is a combination of the things I said. They give you an edge against inflation, the basement of fiat currency, risk of the de-dollarization, social, political, geopolitical risk, environmental risk. So it's a combination of short-term treasuries, gold, some tips, some commodity prices, and some real estate has been public REITs, however, chosen those that are less exposed to the kind of stuff happening in LA or floods or hurricanes and so on. So we have data at the level of individual building, we know the zip code, and we have big data on where the risk of floods, sea level rising, hurricanes, typhoons, fires, droughts is more severe. So we invest into the real estate is more sustainable. So that's
fascinating.
Yeah.
What is the ticker symbol of your ETF?
USAF.
Like the USA Air Force?
Atlas Fund, you know. The fund is called Atlas, so US Atlas Fund. USAF. Yeah, you could say Air Force. It's not
okay.
But easy to remember.
Again, when I edit this, I will put up the ticker there on the screen too as well, Dr. Roubini. Well, folks, look, if you've enjoyed having Dr. Roubini here on this interview, even a fraction as much as I have, please let him know that by hitting the like button, then clicking the subscribe button below, as well as that little bell icon right next to it. And also, if you'd like to get some help in figuring out how to position your portfolio for the type of future ahead that Dr. Roubini mentioned, maybe implementing some of the assets that he mentioned there in your portfolio. If you'd like some help doing so, I highly recommend you get that from a good professional financial advisor and one that takes into account all the macro issues that Dr. Roubini and I talked about here. If you've got a great one who's doing that for you, fantastic. You should stick with them. But if not, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel every week. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. These consultations are totally free. There's no commitments expected. It's just a free public service that these financial advisors offer to help as many people as possible position as prudently as possible for what may lie ahead. And while you're there at Thoughtful Money, don't forget to go to thoughtfulmoney.com/conference and sign up for Thoughtful Money's spring online conference, which is coming up pretty fast, folks. It's going to be on Saturday, March 15th. I haven't been mentioning this enough, but don't worry if you can't watch the event live. Replay videos of the entire event, all the presentations, all the Q&As will be sent to everybody afterwards who registers. And the faculty is just spectacular. You've probably heard me mention this, but we've got Lacey Hunt kicking it off with a keynote with a ton of charts. We've got Luke Groman, Brent Johnson, Lynn Alden, Michael Howe, Darius Dale, Sven Henrik, Daniel DiMartino Booth, Tom Hennig, Louis Vincent Gove, Melody Wright, Steve Bavaria, Jeff Clark, We've got a couple other few big names that have not been announced yet, but are going to be announced soon too. So that amazing roster is getting even better, folks. So highly recommend that you go sign up now, because the early bird price, the lowest price that we're offering, isn't going to be around for too much longer. Also a reminder too that if you are a premium subscriber to our Substack, you get $50 off of that early bird price with the code that we've mailed off to you. Dr. Roubini, this has been a fantastic conversation. I really very much enjoyed it. I hope we can have you back on at some point in the future. And if anything in your outlook changes at some point materially, you'd like to get the word out on, please let me know. And you're welcome back here on the program anytime.
Thank you. It was a real pleasure.
Thank you.
Thank you to all the listeners. Goodbye.
Really appreciate it. And everybody else, thanks so much for watching.